Hello, I'm Chris Didier, and welcome to the Bear Generational Wealth Group's second quarter market and economic update. I'm going to go through this information fairly quickly. So if anything I say should raise a question for you, feel free to reach out to me. My phone number, direct line is 414-765-7095, or you can send me an email at cdidier@rwbaird.com. Okay, let's get into it. All right, so how did we do in the first quarter? Well, for the most part, as you can see by the chart, more risky assets were positive in the quarter. One asset class that I'm not showing on there from a more risky standpoint is real estate, which, on aggregate was down minus 1.5%. Now, obviously, different kinds of real estates did differently than that, but in general, real estate was impacted by the same thing that impacted fixed income, which was down about anywhere from just under 0 to minus 5%. And that was interest rates moving higher. So those two areas kind of get impacted by that. Bonds get impacted when interest rates move up, as does real estate. In this particular chart, I mean, this is small cap right here. Small cap was also impacted by that because about 20% of the small cap index is bank and real estate. And so that had a similar impact on small cap. So where are we in the market cycle? We always want to start every quarter by thinking about where we are at today. The beginning of the quarter, we were in this area of optimism. And as we expected, we were going to go on the upswing. We were going to go on the upswing, okay, towards euphoria. We're kind of at thrill. We're not all the way at euphoria yet, but we expect this to continue to move up. And that could happen in a relatively short period of time. So maybe this quarter, maybe next quarter. But what we're going to look at that is, if we get to those levels, and that's going to be more of an area to look to reduce more risky exposure. And so we'll talk about that as we go through. All right, so why do we say that? Well, individual investor allocations have gotten to levels now close to the 70% area where, that's sort of rare. And historically in the past, those areas have been followed by stock market corrections. And so we wouldn't expect this to be that much different. We're almost there. We expected that we're going to move up there, and it's probably going to happen relatively soon. With that, valuations are another indicator of that same thing. So currently, we've shot above the 95th percentile in the CAPE ratio. And we know when we're above that, future expected returns are not as good, not attractive for long-term investment when you're looking at 3.9% expected return above that line. In the scheme of things, money market cash can earn higher than that right now. And so, well, we see this could continue to move higher. And why could that move higher? Well, it's primarily because of the amount of cash that's in the system still from post-COVID. If you think about it, historically, cash represents, by cash, I mean cash that businesses have and retail money markets, they usually represent about 75% of GDP. Well, that's running at about 88% of GDP today. And that means that there's about $2.5 trillion more in the economy than what there should be. And that, is going to go a long way to supporting valuations. Should we have a correction? We may be in the middle of one right now, but should we have a correction, we don't expect it to be very, very strong because the cash comes into the market and supports it. And same for the economy. We expect the cash just to continue to be a support for the overall economy. And that's really a big part of household net worth. You can see household net worth, really high levels of household net worth really drive the wealth effect in the economy. We are a consumption-based economy, so the wealthier people feel, the more that they consume. And that's at a record level now. We're seeing that continue to be very, very strong, and that's supporting consumer demand. So that's people's, the value of their house, the value of their portfolio, et cetera. Those things are all up. Household net worth is up, wealth effect strong, demand strong. One of the other things that's really contributing to some of the backdrop in the economy, the strength in the economy, is real average household or real average hourly earnings have continued to move higher. So they are trending up And this is a very positive thing for the economy. And one of the reasons that the some of the sentiment indicators out there, the University of Michigan Consumer Sentiment Indicators is positive and showing some strength and resiliency, and so continuation demand. But this is at a slowing pace here. So you see that slowing down. If you look at that, we're not that much different than we were right here, right before the pandemic. And so from that perspective, there's going to be some discontent in the economy, because keep in mind, 50% of our population doesn't own any financial assets, so they're not benefiting from that wealth effect. They just benefit from average hourly earnings moving higher, and adjusted for inflation, that's what we're looking at here. So we will need that to keep trending up in order for continued demand to be strong in the economy. Okay, inflation. So demand has caused inflation, and this is one indicator that we look at, which is Manufacturing Business Outlook Survey. So you can see the dark blue line is the survey data, the light blue line is inflation. You can see the inflation followed it up, and when that manufacturing survey was coming down, inflation followed it down. But what's going on right now? So we're looking at this and saying, well, gee, this indicator is saying that inflation may continue to fall, but it's staying, the actual inflation number is staying sticky right here. The recent number just out was about 3.5%, kind of stayed sticky at that level. And so that could be because the survey data, Manufacturing Business Outlook survey data, is not captured the last month of the quarter. And that was pretty strong for some of the inputs for manufacturing, such as, steel, iron, copper. A lot of these metals and even plastics were up pretty significantly in the last month of the quarter. So we'll watch that as we get into the next quarter and see if that turns. If it stays down here and stays low, well, then that's an indication that maybe inflation has a little bit further to drop. If this turns around and starts to go up, we're going to be a little bit more concerned about where inflation is going to go from there. And we know, we've been watching for the when, 87% of the time, historically speaking, a second wave of inflation follows that first wave. So at some point in time, we're going to see this inflation number start to go like that. And long-term, probably going to be somewhat problematic when that starts to happen. Okay, what's driving it? One of the major things from our perspective is energy prices. I mean, energy prices, this is what we're showing here. We're showing both electricity, which is up here, and we're showing crude right here. So crude oil, as I mentioned already, was up 17% in the quarter, and so that's kind of headed higher. Gas prices are rising as a reflection of that. So gas prices year to date are up about 13, I think today, as of today, probably closer to 15%. So at $3.50 a gallon on the national average, and if that should move up when we get into the peak driving season, as we're approaching summer right now, should that move up to about the $4 or even go above $4, that's going to put some really significant political pressure on our president as he's running for election. That's going to be somewhat problematic, and we'll see how that pans out. But that's going to generally not bode well for people in terms of their economic expectations or outlook at that point in time. One of the other things that is really kind of goes unnoticed is really electricity. So electricity is up 23% in the last 3 years. We think of the reason it's gone unnoticed is because we think of electricity, you can plug in anywhere, and we think of it in terms like water. Well, maybe that's going to change. And one of the things, the driving forces behind that possibly changing, and one of the reasons electricity didn't come down with other energy, is that there's such a huge demand from data centers, particularly AI data centers. McKinsey did a study recently that said that basically from where they're looking at it is that in the next 5 to 7 years, so by 2030 really, the amount of electricity required to meet AI demand is going to be double what it is today. So double. So let's put that in perspective. That would mean that in order to meet that demand, I mean, you can meet it a variety of ways, but one way would be to build more nuclear power plants. That would require the building, the permitting, regulatory approvals, and building of 15 to 18 nuclear reactors. Now think about that. We only have 54 in operation today. That would be a 30% increase in just the next 5 to 7 years. So that's going to be a real challenge and something we expect that it's going to continue to put pressure on our electricity prices and in turn inflation. I don't hear too many people saying that AI could in fact be inflationary, but that's kind of what we're seeing. Okay, the dollar. So, if you've watched this, we follow the dollar for a while now, and the reason we follow it is because the dollar kind of moves in, cycles up and down like this. And so we're not in the camp. Then there's some people out there that think the dollar is about to have a precipitous drop. I mean, we think the U.S. economy relative to the world is just too darn strong still, and maintains this sort of position of dominance around the world. And so therefore the dollar will remain that position. But the reason we look at it is that when you have a rising dollar, you can see how asset classes perform differently. So large and really equities in general do quite well. Things like gold and oil do not do well when the dollar is rising. That flips, as you can see here, when a dollar is falling. So as it fell most of the 2000s, gold, oil did well, and stocks did not do well. Look at large cap was down -1% on average for 10 years. That's 10 years of -1% return each year. I don't think too many investors would tolerate that today. But let's look at what's going on right now. So we've been expecting maybe the dollar will go into a cyclical decline and things like oil and gold would do better. It turns out they have done better, but the dollar's kind of hold up. So what's going on there? Well, what's happening is that right now, as I mentioned, the U.S. economy is still relatively the strongest in the world. Interest rates, or 10-year longer-term interest rates, have stayed higher, and so that's attracting money to come in from overseas to take advantage of those higher rates. But something else is going on there, and that's really it has to do with energy exports in the United States. So if you think about this, in 2016, okay, Congress got rid of a 40-year ban on crude oil and LNG. Basically, the ban was on crude oil, but LNG was loosened up at that same time. So back in 2016, we exported very little crude oil and LNG, particularly to Europe, hardly any. But by last year, so in 2023, our exports to Europe of crude and LNG were 20% of our total exports. Okay, that's a huge number, and certainly something that would support some strength in the dollar. Another thing that's of interest here is gold, because we said that gold's been moving up. Gold's been moving up with very little Western investment interest. So there's actually been net selling inside of ETFs from a gold standpoint, as institutions and investors in the West basically not really wanted to participate in the gold space. But the global central banks have been buying a lot of gold. In fact, in 22 and 23, in both of those years, they bought more than double the amount of gold that they bought on average in the 10 years prior, each of the 10 years prior to that. So that's a significant increase in gold buying, particularly from China. And there's also some gold buying happening from Chinese citizens. Now, that has driven up the price of gold. So now we think that as gold develops some momentum, investors are going to jump on and follow that. So there's probably more upside in gold as we go forward. Okay, the yield curve. So I'm going to talk about this because really it's still the only thing out there that's saying, hey, there's a recession still out in our future. But when is that? So you can see here that when I'm talking about yield curve, what we mean by that is that means that that's when the short rate or the 3-month rate is higher than the long-term rate, the 10-year. That means that's an inverted yield curve, and the curve inverted, before each of these recessionary periods. So the gray bars are the recession. This is basically a graph that shows the 10-year Treasury minus the 3 months. So when it's below that line, it's inverted. Okay, that dotted red line that runs through there. When it's above, that's a normal yield curve. But note something about this: the recession doesn't happen when the curve inverts. It happens when the curve, or shortly after, okay, when the curve normalizes. So when the 10-year rate goes back above 3-month, or the short rate, that's when we would expect to see a recession. So right now, the short rate's around 5.25%. The 10-year somewhere around 4.5%. So if the 10-year should rise above that 5.25, or if the rates get lowered a little bit and they go, that creates a normal yield curve. That's when we'd be looking for recession, and then typically within about 6 months or just around 6 months after that. And it's kind of obvious to us what would cause it. The sort of recession that we're talking about is just rise in 10-year, or really a normalization of the 10-year. We've talked about this before. So what we're showing is the last 30 years, and in this 30-year period, no QE. In this 30-year period, that's when quantitative easing happened. When there was no QE, or in the pre-QE era, if you will, the average rate for the 10-year was 5.4%. Okay, kind of had a range up and down, but 5.4% was the average. With QE, 10 years average about 2.5%. We think those days are gone because we know the Federal Reserve ended its QE program back here in 2022. And look what happened to rates. 10-year rates went higher. They got as high as 5% before coming back down. And a lot of folks were thinking, well, they're going to go back to 2.5%. And we just don't think that's going to happen. We think rates are more in this new normal, and will be similar. So probably averaging this 5.4%. Okay, going forward, but it could range up and down around that. I think that in today's world, an interest rate that moves above 5% gets closer to that normalization of the yield curve, probably starts to scare the market a little bit, and we'll be watching for that, because that would again be something that would slow down really slow down the real estate market, slow down the housing market, slow down a lot in the economy, and probably cause problems for the stock market. Okay, so in summary, right now the market is in this upswing, is headed towards euphoria. It's driven by stronger than expected economy and investor confidence, and we expect that to kind of keep going at least for another quarter or two. And we're seeing individual investors, taking that risk and moving out their allocations to more risky assets. Valuations are getting concerning because they're moved above that line, and we think that these are at levels now where corrections typically happen. So we would expect some sort of corrective activity. Right now, we think that would be fairly muted. I mean, so in the 5 to 10% type magnitude area, but we already can see cash coming in whenever the market tries to pull back a little bit. So that's why we're thinking it's going to, market's going to continue to move up above where we're thrilled and headed to the euphoria area. This is all about, really household net worth and the wealth effect driving things. We're watching this leading indicator of inflation to see if that might hold true, that we might get some, backing off of inflation. But right now, things are looking sticky, and we're looking at energy prices. We're looking at other commodities prices, and we think that there's more inflation for us in the future. Yield curve still there. We're going to wait till the 10-year above the 3-month would be a signal to you that we have to watch out for the recession. And QE, unless something breaks, the Federal Reserve is not likely to go back and restart QE. But we do know from the Silicon Valley Bank data, if something does break, they will jump back in. So what to do now? Okay. We suggest right now you can maintain those allocations to more risky assets and kind of ride up the curve a little bit, but opportunistically, you really have to look to reduce exposure to more risky assets. And again, we'll be talking in terms of 5 to 10%, but we have to really look at the big picture on that, because we want to make sure that we're doing it in a very tax efficient way. So with that, I look forward to any questions that you might have. Please feel free to email me or call me directly, and looking forward to seeing you over the course of the quarter and during our next quarterly report in 3 months. Have a great day.